haircut. I missed my haircut, so finally have it reslated tomorrow. So, and by the way, I have a CNBC thing that I'm doing tomorrow, 7 p.m. Eastern time. So I'll get the haircut right ahead of that and hopefully be presentable. Brian Sullivan must have been hard up for.
I'm like,
yes.
Tim, I've got a good barber if you want, So.
I'm sure you do. People offer all the time. Yes. Nothing that the dog grooming device can't solve. Okay, here we go.
What segment on CNBC are you going to be on?
So typically it's on Last Call with Brian Sullivan. So
okay.
And of course it's the Friday. Everybody's going to be at happy hour, but anyway, usually that's pretty close to the top of the hour. Like, so Eastern time, call it 7:02 or 3, and for 3 or 4 minutes, right in there. I don't even know what I'm going to talk about. A producer will just reach out and say, "Hey, can you do this?" And and as long as it's economics and market structure and monetary policy, I can fake my way through, right? Okay, so it's what is it? It's Thursday, the 7th of September, and this is the Edge live demo and discussion. Thank you for joining. Good to have you here. We appreciate you doing it. And when a lot of people have been on vacation, and I would have been in a couple of weeks, but won't be. Would have been sailing around St. Lucia. I was really looking forward to that. We're going to go stay for a few days in Beckway, which is in the Grenadines. Have been there before. That's a pretty nice part of the world if you've not been, and we'll have to delay that. So back to market structure. I will try to. I've got 4 things to cover, and we can of course talk about anything that you want to. I will share with you the things that I've been experiencing. We've got decent supply demand data in the market. The supply side is not great. If you're new to Edge, let me show you what I mean by that. So I'll share my screen here. Give me a second. Okay. And I have the low volatility portfolio up, but here's what I mean. If you look at the supply demand balance in the market, it's not bad. And again, if you're new, this is a way to wax and wane your exposure to the market and to manage risk. If options are expiring and demand is beginning to decline, they've just expired. This would be back in. Let me zoom that a little bit. So the July expirations here, those 3 little squares that you see there, and the green part of the graph. And if you have difficulty distinguishing between the two, this is the one I'm referring to. This is SPY. And if you hit options expirations and supply starts to rise and demand starts to fall, there's a high probability that the market's going to decline. It's not perfect, but it's a pretty good indicator. And if you look back over the data set, it works pretty well. Brian Wilson, who's on the team and is here, he likes to, when demand's rising and supply is insufficient, then maybe use a leveraged S&P 500 kind of ETF. And when it reverses, then maybe use a leveraged S&P short ETF. It's a very simple way to turn supply and demand to your advantage. And how else would you know? I mean, otherwise, what are you looking at? Price and volume are not metrics. They're consequences of things that are occurring underneath them. And in the stock market, more than half of all of the trading volume comes from traders with an investment horizon of a day or less. That's what high frequency trading is. So those conditions can change all the time. The windows are short, but it's a very effective way to have an advantage. When it bottoms, when demand bottoms and supply has dropped below trend, probably a pretty good likelihood that the market will rise. And you say, well, what's going on now then? And look, it's been kind of a challenging week. There's no question. I have made money and I have been stopped out of positions. And this may have happened to you, particularly in momentum. And so why is that occurring? Well, September can be a challenge. The data aren't perfect, but I would look right here and say, well, the supply side has never receded. Normally, if you go back and look at, again, a long data set, well, let's just do this year to date. And you will generally see that when there's good divergence between supply and demand, we come out of the banking crisis right here, right around options expirations mid-March, and the fear about what might happen to regional banks diminishes, and demand rises, and supply falls. Probably we'll get some gains. And those gains sort of stopped when supply rose sharply over trend. And when it's high, gains in the market are harder to get. When it falls and demand again zooms, then the price rises again. Those conditions, they're not great right now, and that is absolutely an issue. And it makes it harder to produce returns, particularly in momentum. Momentum requires good, strong supply-demand divergence, and we have good demand, but the supply side isn't great. Maybe that tells us that it's better to focus on low volatility. I mean, that's harder to do. Making 1% isn't as exciting as the opportunity to make a larger number than that, of course. Today, I started the day with Vertiv, Barry Norton. I know you like that company, and that's done fine. And here's one of the challenges. Natera, what are you going to do? It's the luck of the draw. They announce a follow-on offering, and that's going to hurt the price. There are things like that. There's no amount of market structure is going to offset that. So I got stopped out of that. I put my stops pretty shallow because I don't want to lose much money. But that's unfortunate. If I look at the supply-demand equation, it should do well, and it sure explains why it wasn't. Right? So there are parties that know that they're going to offer shares to investors again, and it shows up in the data. I mean, without that news, this would be a very nice stock to trade, and certainly that's what I was counting on. Sometimes it just doesn't work, so I immediately deployed that money into Futu. These are higher risks. It's got 5% volatility. For anybody new, we're measuring how much prices move between intraday high and low on average. There is a remarkable amount of volatility in the market. So when it was down, it was down over 7%. Maybe there's a reason for that. I look over here and say, well, active money is the lead behavior. By the way, active money is story. Their fast trading is 52, 53% of overall market volume. It can very easily in some of these be 65, 70% of trading volume. Those are machines. They're not sitting around thinking about news or fundamentals. They're merely trading prices. And they do it with algorithms and sophisticated software and high performance computing systems. And you look across here and see four of the stocks in this portfolio are being led last 30 days by fast trading. Passive money is indexes, ETFs, and quants. Risk management, if you see that, would be derivatives. They're just, no behavior has an advantage over any other behavior because market rules require that no stock market and exchange, which has the prices, give preference to one behavior over another. I can't say, well, I'll accept Citadel's orders, but not Goldman Sachs's. You might be able to do that in the dark pool, but you can't do that on an exchange. So sometimes it works, sometimes it doesn't. But I feel, all other things being equal, is there a good opportunity to make money in Futu? Well, already have. I mean, it's already a good 30 cents up from where it was, and I bought a fair amount of it. It's a fairly low price stock. But again, it's not perfect. It's just it's a very effective way to increase the probability that you're going to produce returns. And I want to show you something here. Moving on to this next point number 2 that I wanted to highlight. You might say, well, I don't want to do that. I don't want to, I don't have the time to sit around and watch something. I would rather have a longer horizon than that. Well, that's pretty easy too. Here's just an example. And I say this is not complicated because it's not very difficult. It doesn't work all the time, but it does consistently work if you follow good rules. So for instance, let's say we want market structure demand that is greater or equal to 9. So we want stuff that's, got excess demand. And you just want to create a portfolio that you're gonna use for a longer range horizon. And we want short volume supply that is less or equal to. There are the two supply and demand equations, and I'll just say less than 50. I don't know that it's worth it to be too precise with that. I like the 5-day downtrend because it statistically repeats as a very good indicator. I've had young Nate, the mathematician, run a bunch of data. I'm going to show you another thing that we have been working on, and when we're comfortable that it works well, we'll share it. But I'll show you some performance data. So we want this to be equal to down, that the 5-day trend is down, not perfect again. It's just an indication that there's a near-term supply deficiency. And I like more liquid stuff. It's easier to get in and out of, and the liquidity has deteriorated. If I backed up 2 years ago, I'd say I'd set the bar at $4,000 a trade. So that just means how much money can I trade before the price changes on me, and it's a pretty good read. So now maybe it has to be a little less than that. I'm just going to do this for the sake of example. 2,000. I've got an example that one of you users sent to me about a stock and said, the stock has been really good. Why does it never show up in the momentum portfolio? And I'll show you here in just a moment. So now we've got supply-demand divergence, probably. We have declining supply. We have reasonable liquidity. And so maybe this is a good way to filter. And you can create this very easily. This will probably give us a fair number of stocks over 90. So I'm going to narrow that a little bit because I don't want that many choices. Doesn't mean you can't do this some other way. I'm going to take the top 20 out of this. So now that could become my portfolio. And maybe I sort it by market cap. I don't like small caps because they're harder. They aren't performing as well because there isn't as much money chasing them. It's that simple. The products that do the best are the ones with a lot of money that wants to own them. So just like that, you could create a portfolio and allocate money to 10 or 20 different stocks. And when they drop out of that portfolio, you get rid of them and you add something else from the list. And it works very, very effectively. I'll show you some performance data here. This is just an example. I think I've mentioned, and if I haven't, I have had one of our software engineers working on a performance module that would become a replacement for Profiler, the very early backtesting engine. And so this utility will look for certain things. So I ran this between July 5th and September 5th, and it looks at it like portfolio performance. So initial value of $10,000 in this portfolio. And I set a fund count, number of stocks in the fund at 20. Interest rate has to do with, what if you're parking cash? You could change, can you get 5%? Close to it, probably closer to 4.5. Then how many would you replace at a time, and how many do you have to have? And what these fives mean is that I will replace if I'm down to, let's say I can't find 20 and I'm down to 10. I'm only going to replace 5. I'm not going to replace them all. And I'm going to keep at least 5 stocks in the portfolio. And what I'm looking for is the very same thing I just ran. Sentiment that is greater than $9 per day. This is a liquidity read. It's another way to do it. I want stocks with $100 million of dollars per day. You could do that with volume. There are a variety of ways to look at liquidity. There is that short volume trend, 5-day equal to down. That's what it is, less than 0. And short volume, less than 50%. And I wanted stocks with a price of at least $20. So that's what that means. And then what do I sell? I sell when sentiment declines or short volume rises over, it could be anything, but I just put 55%, 10% increase. 10% increase from my upper bound. And so then we just ran the data over that period of time. And it's kind of remarkable. So the initial basket is here. And this would be on whatever, July 5th. And but it's a lot of data. But by the time you get to the end of this, it made 23.8% just doing that in 2 months in a market that did not perform very well. And I'll make sure that we vet all this data because, we do that. Is there an error in the data? I certainly want to know, but we've vetted this pretty well. It's an illustration of the benefit of making sure you stack your money in things that have excess demand. That's really it. And at times it can be very frustrating. Look, it's frustrating to me when I've got a pretty sizable position in Natera, and I get stopped out. I don't like that. And it doesn't work all the time. Sometimes in these conditions, it can be challenging. But the beautiful thing about Edge is it's predicated on the mechanics and behaviors of the market, the rules that exist today. I'm going to go to this one that I received an email about, had a nice exchange about it. And this guy's a big trader. And he said, how come this thing doesn't show up in the momentum portfolio? Look at that. I mean, that's exactly the stuff that you want to find. Very strong demand. It's been at 10 most of the last 30 days, and the 30-day supply trend is down, and those levels are 28%. So the only reason that this stock doesn't show up in the momentum portfolio, those are very good characteristics. You can look for those things. How much time has something spent out of the last 30 days at 10? You can do that. So it's in the energy portfolio. I didn't know that. But let's go find it, and we'll look at the other characteristics and understand why it's not in the portfolio. And there's your answer. So it's a hard stock to get in and out of. I mean, it trades 5.5 million shares a day. Market cap's 1.7 billion. It's a Russell 2000 stock, not a Russell 1000 stock. I tend to concentrate on those 4.5% intraday volatility. But there's the reason. It only trades $1,300 at a time. And so in the momentum portfolio, we set a minimum of 3,000, more than twice that much in terms of the liquidity factors that we want to look at. So you'll notice here, if you look at dollars per trade, that's what you see. The smallest, the least liquid stock in the list here is actually this. I think this is an ADR, and that explains it. Yeah, KEO Holdings, it's a Chinese company. ADRs are challenging too. They are an arbitrage vehicle. If you have an underlying basket of common shares and an American depository receipt that trades against that, it's a lot like an ETF. There's an underlying basket and a representative vehicle that is going to vary and get arbitraged up and down. Well, we can use that to our advantage, but the time frames will be narrow, and volatility tends to be high in those things. But it's more than, it's almost 3 times as liquid as UEC up here. So that's just a way to think about the data and what you want to do if you have a longer horizon. And to me, the importance of liquidity. Okay, so any questions, comments, observations? Anybody want to share your recent experiences? Pam. Yes, please, Pam, go ahead. What you got? Nice to see you.
Hey, Tim, can you hear me? Hey,
I
nice
can.
to see you. Great. Sorry, for some reason, Teams won't let me type in the chat box. So I was just curious on the filter you just ran, the scenario from whatever. You were buying when all of those stocks were at least 50% down their volatility from the prior day's close, and you were exiting on your exit criteria. Is that right?
When I trade, I do that in this model. And here's the interesting thing. Statistically, what we're finding, and look, I like to do that. I'm going to sound like I'm contradicting myself, but I've had Nate doing a lot of work on that data, and really there is not a lot of statistical difference between buying the closing price. So in this case, in the model, what we had this model do is just buy the price of the day, and there's very little statistical difference between, say, taking the midpoint price, very easy for us to do, or just taking the closing price and saying, well, that's your entry price. We know it might be a little bit different than that, and then hold it till the exit criteria are triggered. That doing that is statistically no different than buying down half the intraday volatility. Buying down half the intraday volatility is a shorter horizon trade. When I do that personally, I'm trading for 2 or 3 days. That's it. My aim is if it's down 2.5% in the next 1 to 3 days, could even be today, I want to make 2.5%. Something like that. If it's the momentum portfolio, but in this model here, it made no difference, and that ought to be kind of heartening. It tells you that if your horizon is longer, and how long were these stocks in the portfolio? I don't know. I'd have to go look at them and see exactly what it is, but I would say it's closer to 15 days that these positions would be in the portfolio. That in that time frame, if you have excess demand and insufficient supply, that it doesn't matter what your entry price is, statistically.
That's excellent. Thank you.
Yeah, it is excellent, right? When Nate came back with that data, I said, "Are you sure?" He said, "Look, I've run it, this way and that way, and it keeps coming back to this." And in this case, it was the likelihood of producing a positive return in those positions, and we set a bar on that of 2%. So 2% or better was over 72%. That's not perfect. It means that 28% of the time you might not, but clearly it works. And it's the only disappointing thing to me is there are not very many stocks that meet those criteria. I mean, you got 3,100 stocks in our universe, roughly. I think of it as the Russell 3000, and finding stocks that are going to do that consistently is very difficult. And I think this is what big institutions run into. I mean, how do you get a bunch of stocks that are going to give you returns? It's very, very difficult. Okay, what else we got? Now, Brian gets all the questions. When I'm here, he's doing a better job at this, I think.
Any Tim, one question there about the blackout days. Did you black out any days in that experiment?
We did not, and that's an excellent question. Could we skip options expiration dates? And we have run that data too. We've also run data that uses broad sentiment as a risk management modulator, meaning when demand falls. So we have 2 days where demand declines from a peak, and supply rises a certain percent, about 10%. That we quit the market and park it in cash, and the returns improve. There is no question returns improve, and you can trade half as many days and produce a better return that way. And it really points to how important it is to reduce volatility, and that's what we're doing. If we say, okay, we're going to take money out because the broad sentiment got to 6.6, 6.5, 6.4, up, we're out. And the supply side rises, and then you wait for it to bottom and supply to decline, and then you put your money back in. We find that we're only in the market about half the trading days, and it produces vastly superior returns. I have not got, when we get this mathematically refined to where I'm comfortable that we can back it up and demonstrate it repeatedly, then we'll share it. But I know that it works because I spend half my time running data. That's what I'm doing. I'm looking at these data points to see what can work better. Dan, how many stocks contributed to the total return? Let's see. I'll have to go do a unique count and see. My estimate, just looking at the data set, is that it's no more than 40. Now, I could be wrong. I'm going to look at that again to see. It's a very good question. On September 5th, these were the stocks that the portfolio owned, and some of those were there the whole time. There's VRT. See, it picked up VRT, picked up TTD, picked up some of these stocks that have been great performers, picked up NVIDIA, of course, because that's going to show up over and over in the data. But it's really nice to have a machine do all that work for you. Just find it for you, right? And it's going to do a pretty good job at that. Was I using stops in my positions or in models? Yes, I have been using stops personally. When demand's rising and supply isn't, I take off my limits oftentimes in the volatility in the momentum portfolio, because might as well just hope, that you can take whatever you get. But I do keep my stops in, and yes, it drives me batty because I know what happens with those orders. I know that the moment I have put in a limit order, which it is, now somebody knows. Somebody knows, and it does happen more frequently that if it's if I'm down 50 basis points, and if here's how I'm doing that. If a stock has 4% volatility, and let's say I bought it down 2.8%, so then I will put my stop down pretty close to 4.5. Well, sometimes I'm going to get taken out of in this with the stop set that close. And it's a risk, right? And I absolutely believe that the people who buy order flow that gets sold like that can see it, because what will happen is there must be a number of us who do that. Then the price moves through us and then immediately recovers, right? Have you had that happen to you? Yeah. Well, how does that happen? Well, it's the risk of using limit orders. It's why I love to buy things with marketable trades, because nobody can move the price on me. I'm going to get the best trade. No one's going to have an advantage. If I put in a limit, now somebody out there has an order in the pipeline, and they can see, well, we could take out all those orders and move it. And I think that also applies versus the options market. And you say, well, that sounds illegal. No, it's not. It's the way that retail order flow is sold. But when there is excess demand, the machines don't care about that, because the whole market will be moving in a direction that is helpful to us. When supply is as high as it is, I think there is a greater risk of being stopped out. There's just no question that there is more of the market that is biased short, and who's going to know? All the machines consuming all the proprietary data feeds with their machines located right next to the exchanges or the servers of Credit Suisse and UBS, and they're going to consume all that data, and they're going to know. They're going to know, well, there's a bias to the short side of the market, and that's going to hit us. So then what do we do in response to that? I keep coming back to the same thing, and Dan Eisenberg, I know you'll say, well, I don't believe that the data are statistically significant to support this point, and you may be right, but I think we have to trade low volatility when that condition exists, because it's more likely that trade will be crowded, and it will be harder to get returns and momentum. Maybe, I like to trade momentum. I do, because there's a better chance of producing 2, 3, 4, 5%. And that's more fun. It's more fun than 1%. But losing money isn't fun. So I don't know. Brian, you might want to weigh in on that. But that's I know these things to be true. All right. Yep. I had this debate with Doug Sifu, the CEO of Virtu, about 5 years ago. And I said, you could buy retail order flow and furnish it at an exchange for a rebate, and you could make money both directions. And he said, no, you can't do that. 2 years later, they got into that business, and it's exactly what they do, and they dominate that business. And I've talked to him since about that. So you absolutely can. And what I just said is they will buy a retail trade and go to the NYSE and price the market with that trade and get paid for it. Well, that's how we get volatility. And when there's a breakdown, when there are more stops than limits, which way is the market going to go? Well, they're going to know. And that's how we get stopped out, Barry Bailey, Dan Eisenberg. I mean, it happens to us. And yeah, that's why. So then what is the defense against that? Well, there are only two choices: sit in cash, trade low volatility. Low volatility, it takes a lot of the risk out of it. Pam, did you have another? You want to weigh in again?
I do.
Yeah.
I do, Tim. I have a follow-up question. And okay. I think that guy owes you some kind of rebate or commission on that idea, but that's another story. Yep. So let's just say you did that filter and you came up, I think, with 90 names, but you want to focus on a small basket so you don't have so many to watch, and you want to say have 5. What would you narrow that down with if you had to pick, I don't know, one of your criteria to have, say, the best backs? Let's say you want to take $100,000 and divvy it up among 5 positions.
Yep.
How would you filter that to get the best 5 to trade?
This is what I would do. And here's the way to do that. This is where you could use these sorting capabilities to good effect. So for instance, maybe you do market cap. I want to have the largest market cap, and I want to have lowest volatility. Let me do it reverse. All right. Let's see. Okay. I didn't do that right. That's what I would do, though. I would say I want the biggest market cap, and if it's it, and in this case, if you're willing to take a little more risk, maybe you take the upper range and say, okay, I'll screen out the ones that are 1, and I'll take the ones that are between 1.1 and 1.8% because maybe I can get a little more return. But you could take 5 that way very easily. I use this stuff all the time for those to give myself a little advantage in a sort. Maybe I want supply that's in a particular range. You could do that by range. You could just say, well, I want to look at supply that is only 30 to 40. That's a great way to narrow your set down to your 5. And I'll say again that I think if you have the same general characteristics, it is like a herd. It is, there are differences there, but what you're doing is saying these things look very similar to machines. And that's very important. They look wholly different to stock pickers. A stock picker is going to look at, Novartis and UPS and see something wholly different. But a machine's only going to say, oh, those are exactly the same kind of product. That's what I trade. And so that can help you. That's what I would do. What is it? Is it less supply? Is it they're bottomed instead of topped? Is it market cap? Is it volatility? Those are all things that I would use.
Great, thank you.
Brian, you can weigh in if you want on that, if you have better input. Let's see. Alex, the effective dates for that simulation were July 5th to September 5th. And it's just an example. I wanted to look, and the reason that we did that is just to look at a period where the market, going back to the broad sentiment view here, so here's July 5th. So we caught a bottom and a peak for stocks and a bad stretch where things didn't perform well. So looking at that kind of market, is it where there were basically 3 different things. There were 3 different kinds of markets. There was momentum, there was a period of declines and a period of recovery, but with high supply, which would be more like low volatility. How did it do? Well, it did pretty well. And I'm running all kinds of criteria all the time. I mean, it's on a different machine, or I'd show you I'm doing a lot of simulations to check. And longer range, 3 years, shorter periods of time during periods of difficulty in the market. But in this case, that's what it was. Let's see. One more thing here.
One additional question, Tim, at the end of the discussion.
Yeah.
Down at the bottom.
I was surprised at how little turnover there was, because we have certainly run simulations where I felt like it was too much. Like every day the portfolio was turning over. And this, by having just 2 exit criteria, and they were or, not and, so it could be one or the other, declining demand or supply that rose basically 10% to 55%. The turnover was surprisingly light, and I've run that same mix over considerable periods of time, and it doesn't work all the time. I was talking with our institutional partner. We have one institutional partner for distribution to that audience called Point Focal, and I was talking with Thomas there about why in 2022 was it so difficult. The data performed very well. And then in 2022, the performance declined. And interestingly, I ran low volatility for all of 2022. And no matter how I tweaked with those criteria, the model would not give me anything till August. I kid you not. No amount of working to get a low volatility portfolio, I'd run it, nothing. August, it gives me a basket. And that happened over and over. And I concluded that 2022 was uninvestable from a quantitative standpoint until August. And that portfolio produced a 6% return. Now, that's not very good, but versus what the market did in 2022, it was really quite compelling. It would have said, don't do anything till August. Well, you don't get a return that way, I recognize, but you also don't lose money. So I'll keep working on this. And again, I look, if I could, I just give this stuff to you on the platform now, but it has to be fully vetted. John Cook, I know you're chomping at the bit for that stuff. Okay, I've used up my time, and it's good enough. I've covered most of what I wanted to cover. We could talk a little bit about what's ahead. Next week. So September options expirations are also a quarterly rebalance. S&P quarterly rebalances. There've been some pretty big rejigger. There was even a Wall Street Journal article about this. There's a lot of movement in the S&P 500. They've replaced 20 names this year already, and so those can be very impactful. There's so much tied to the derivatives associated with the S&P 500, and it's a split month. Doesn't happen very often. Meaning their options expirations the 14th and 15th. And then VIX expirations on the 20th. Well, you get a great volatility spread trade that way between the rebalances and then the VIX expiration the following week. Tough stuff there. I'm going to be, I've got an Interactive Brokers webinar on the 13th, right ahead of that, and I'm going to, the title is, to me, amusingly, how many rich technical traders do you know? Now, maybe some of you are. I'm not a technical trader. I said this to the global head of data products for Interactive Brokers. I said, Yohai, how many rich technical traders do you know? Any? He said, I know two. He deadpanned that, but it's a funny line, But how many rich quantitative traders do you know? I can rattle a list as long as my arm off, right? From Ken Griffin to Jim Simons, there are all kinds of very wealthy people who trade market structure data quantitatively. So there must be something to that, right? Okay, that's all I've got. And it wasn't great. I warned you that I wasn't going to be very good at this today. but what I want to leave you with is it's pretty simple. There are times when you shouldn't be doing things, and always focus on the supply-demand divergences. If your performance is struggling, it's probably on the supply side more than the demand side. Supply is high, it drags the boats down in the water. There's just no doubt about that. And maybe the best defense is trade low volatility. Be happy with 1%. I mean, 1% every few days is really good, frankly.
Tim, quick question. What do you think happens with, quarterly OPEXs are really big, right? In terms of like moving the market. So we're going to probably pin into it, and you get that. But if supply stays high into that, what do you think is going to happen? Because to your point in the note this morning, like, is the market setting up for being short into kind of the back half of September and October, potentially before seasonality comes in a little bit?
If that holds, yes. And I think if it's a weak top, we used to say weak tops precede drops. It might be a little too trite, and I'm not sure that the data is that statistically significant, but we did used to find that to be true. We were looking at that from the standpoint of public companies, telling them, okay, well, if the broad sentiment creeps up to 6 and that's as high as it gets, we'll look out. There'll be downside pressure. And so we'll see what happens this time around. But yeah, I mean, I look at the data. It's interesting, the disconnect between the economic data, which appear to be pretty good. I'm suspicious of those data because I'm here. I have my hands in among big public companies, and I see it a lot that people are having a hard time. So I have a hard time believing that data, right? And I think that the market is a better read, and it's short. It's over 50% short, and right. I agree with you. If that prevails through that rebalance, it's going to be very difficult in the equity market in the second half. Could be, at least in the fourth quarter. So we'll see. Yeah. On that happy note, look, there'll always be things to trade. That's the beautiful thing is the math will always give you something to trade. This might be less than other times. All right, you guys. Thank you very much. Good to see
Cheers.
you. All right. Catch you next week.
Thanks, Tim. Take care.
Thank you, Pam. You too.
Thanks, Tim.
See you, Barry.